All right, cool. I think we're good to go now. We might have more people trickle in later on. So if you see more people pop up, no worries. We'll get everybody in line for questions and all that. So everybody, welcome Darren Klein. Darren Klein's with the Terra Group. We have sent a few scenarios over to Terra. We haven't funded anything yet. But I did want to take, this time today to just bring Terra on, let Darren speak for himself, explain to us, what he has to offer in the marketplace. So, Darren, if you would like, I'm going to give you the ability to share your screen.
Okay.
Would you like to share your screen today to present anything, or how would you like to go about?
Yeah, I'll set up some follow-up information
Sure.
post call. Yeah.
That's great. If you
Yeah.
don't mind, I'm going to share my screen while you're talking, just to kind of
Please.
give people a visual of your website. And so, yeah, everybody meet Darren. Darren, if you wouldn't mind telling us about yourself, the Terra Group, kind of a little bit about, where you guys got your start, if you have any history on it, and then just get into the details, what kind of deals you guys are looking for, what kind of deals you fund, and we'll get into a Q&A session at the end.
Great. Thanks for having me, John. Thanks and Charlotte for getting it all firmed up, and I really appreciate the follow-up. Nice to meet y'all. Yeah, I'll just give you a quick background on Terra Cotta, and certainly feel free to interject at any time. So we're based down in LA. No judgment there, please. And we've been around for 20 years. Currently, so when we first started, we were small friends and family type of high net worth, hard money type of group. We did some residential and some commercial. And then in the GFC hit, we started buying non-performing loans, which we bought about 150 of them, and did workout or foreclosure or whatever got us the best yield. And then when that opportunity wound down, we got into the bridge space. And so all of our bridge execution is done out of a fully discretionary fund on behalf of predominantly institutions now, for the most part, along with all our high net worth investors that were with us earlier on since inception. That fund's got about $1 billion lending capacity, and we'll get more into the parameters, but it generally focuses on value add commercial real estate bridge transactions across the Western U.S. with a deal size of $10 to $100 million. Inclusive of the 4 major CRE groups. We're doing life science, medical office, and IOS yards, which we've been doing for a long time now. And so we can be supportive, probably best in the scenarios you're asking about, John, in instances where you need heavy lift type of finance, quick close type of finance, or just a lot of structure with some optionality to it. We can, like I said, we can move quick and with certainty. So there's no type of outside approval. There's no CLO execution in our bridge program. So everything's balance sheet and comes off the balance sheet to originate. So that's the bridge program. We're also launching right now an equity program that's got a couple different strategies within that program, but the fund profile is pretty similar to the bridge program in that it's a fully discretionary. That fund has equity fund rather has got $1.5 billion capacity, and the target, the thesis behind those that product is to probably not as much relate to your guys' day to day, but I'm sure you run into the opportunities from time to time, is to buy non-performing debt again. So we're in the midst of that. We're actually starting to see a good amount of opportunity, of course, in the office NPL space, but we've just tied up a 12 loan NPL portfolio for multi, which is pretty exciting. That's about $100 million. And so we're doing that. And then as it relates to, more borrower specific stuff, that equity program is intended to be a liquidity tool at the opco or holding co level. Can also come in the form of common LP and pref equity. So that I yammered on, but that's high level about us, our history, and the 2 CRE products we have on the market.
That's perfect. I appreciate that, Darren. Thank you so much. So let's talk about your map real quick. You mentioned the Western United States, right? So Can you kind of hone in on that a bit? I don't see it on your website, locations primarily. So,
Yeah.
what are we talking in terms of locations?
Yeah. So bridge program is geographically focused Western US, so Texas to Seattle,
Okay,
primary and secondary markets within. And then the equity strategy is national.
got it. What about your minimum to max loan amounts? What's the smallest kind of deal you're looking for? Largest kind of deal?
Yeah, minimum deal is 10, largest deal is 100. We can do smaller type of execution for a repeat relationship. It's just our due diligence cost gets a little too impactful once we get, under 10, $5 million where the borrower is just like, she's, this is structured finance, but I could have paid a little bit more on spread to do more kind of a hard money execution and not pay as much on the diligence. So we just try to shy away from any like potential dissatisfaction with the product, not the execution of it, but it just doesn't behoove you if it's on the smaller side as a borrower.
Is it because of the upfront costs?
It's because of upfront costs is a point in, and the exit fees generally a point out on the bridge program. It's usually the legal, it's probably going to be 20 to $30,000, and once you're under $5 million, it just becomes too
Right.
impactful.
So we have a due diligence fee with Terra Group.
You have a loan processing fee,
Okay, just
probably
to
about
get started.
$5,000.
Okay, so it's only
Yeah,
5 grand to get started for the borrowers. I mean, we're brokering those loans, so we
yeah.
stomach that upfront, cost having to pitch that. So it's only 5 grand to get started. Is that what you're saying?
Yes, generally speaking, and then
Generally.
the origination fee at funding.
Okay, right on. So property type. So everybody heard it, 10 to 100 million. That's what they're looking for. Did I hear you'll consider something below 10 million, around 5, but you shy away from it for the most part?
For a new relationship, yeah. For an existing relationship, we can do some smaller stuff because we've already got docs,
Okay.
and we can manage those diligence costs a lot more efficiently.
I got you. I got you. Okay, property types. I mean, you guys are on the commercial side. Can you kind of dig into the property types? Multifamily, will you do
Sure.
urban developments? I mean, single family developments, or are we strictly commercial over here?
Just commercial, no ground up, heavy value add. We'll do no SFR. Within the commercial, you've got the four majors, and then life science, medical office, IOS yards. We've done quite a bit of those over the last 4 or 5 years.
Right on. Okay. iOS yards. Can you clarify, brother?
Yeah, yeah. Industrial outside storage.
Okay.
Years ago, people used to call that a land deal. Now it's part of the industrial asset class. So it's
Okay.
become kind of a sexy little new product.
Oh.
And we just been doing a lot of that. It's just for logistics. You probably see more of it if you're in and around a port.
Yep.
Which, being down here in LA, obviously we see a lot of that, but it's just logistics yard for, trailer trucks, last mile type of distribution. Amazon's taking these yards and FedEx, they see out there park their trucks. Those are all iOS yards.
Yep. No, I got you. Okay. And then
Mhm.
your guys' terms, I mean, 24, 36 month IO style terms, or what are we talking?
Yeah, can get down to 12-month terms. We can give you open prepay after the first half of the loan term. So in essence, if you needed an 8-month loan, we could do it, and then we could stretch all the way out to 3 or 4 years. Our
Okay.
spreads are the tight spreads that we have is like in the fours over SOFR. So doing that kind of spread profile for 4 years, doesn't make a whole ton of sense. But if you need that kind of bridge to get some execution, we just did another retail deal up in Tacoma, and they needed some time to get separate parcelization so they could do some releasing.
Right.
And then they needed to move in a couple of key tenants that really kind of compress cap rates to make it even more profitable for them.
What about interest reserves built in?
Yeah, we'll build an interest reserve. It's typically going to be full term. Probably get some pushback on that. Folks are trying to limit that, which I get. But yeah, we'll certainly have an interest reserve.
Okay. All right. Those are the key questions that I have to like your primary product that you mentioned earlier. I want to dig into the equity side and these bailout style loans that I'm hearing from you.
Yeah.
So I want to dig into that here in a second. But before I get to that, does anybody have any questions on Darren's like primary bridge product? It sounds like it's been your bread and butter for a while, Darren. Anybody have any questions concerning that primary product before we get into like the maybe mezzanine style financing that they have set up? And if you're muted, you might be muted, so you're gonna have to unmute yourself. I'm gonna give it just a couple seconds for anybody to chime in.
Yeah, I think just to add, just to give some people some orientation. I mean, as far as our competition, we usually compete with, of course, we're better, but we always compete with, the RRAs, the thoroughfares, the A10s, the Buchanan Street, just to give you a sense of kind of where we play, if that gives you a better orientation, if you're more familiar with those type of groups.
Sure. We use Bloom. You're sounding like a Bloomfield to me.
Bluefield too. Yeah, Bluefield. Actually a good comparison. Yeah.
Yep. A clear exit strategy, it sounds like.
Yeah. They have a fixed program. We don't. All our stuff's variable. But yeah, Bluefield is a good draw.
Yep. Yep. Okay. Well, let's dive into like this equity side. So everybody's kind of got their own preferred way of doing it, but I will say a lot of what we're seeing right now are bridge loans trying to refinance. And I've been talking to a lot of people. I think this is a great play for any equity firms, equity investment firms to just come in,
Yeah.
bail these guys out who don't qualify for the takeout. Maybe they'll bail them out in a way for a large equity position. You might be speaking a different language, but this is what we're seeing. A lot of bridge loans coming due, ARMs.
Yeah.
They're trying to refinance into the perm loan, and they're not debt servicing. So they're in a seriously tight position where they have to now come to the table with more money on the refinance in order to debt service on these loans coming out. And so I'm curious, tell me about that other, do you have a solution for these guys who are coming on these ARMs or these bridge loans and they can't reposture into the 30-year and they need more money? Are you playing in that space or what's
Yeah.
your new product strategy? Give us some meat, because that's something that we're trying to kind of solve for our clients right now.
Yeah, and I think we're trying to it's just launching, so we actually haven't deployed yet in that strategy. And I mentioned, that part of that strategy is going to be buying non-performing debt, but that wasn't your question. We go ahead.
It's almost non-performing. It's getting
Yeah,
to the point. It will be
yeah,
non-performing.
yeah. So a
But
little bit
if we
before
could get
that,
in
right?
early, my question is if we could get in early, we might be able to make a better deal for those.
Yeah,
Like get with the borrower instead of the lender on the non-performing, because we're getting maturing notes. We can't refinance. And it's like find an equity partner to put up that extra money to get into the perm loan.
yeah.
But yeah, you tell me
I
where
think
you're
if
at.
we in that scenario, yeah, I agree with you. We ideally get to that situation a little bit earlier before it got to a non-performing situation. But that the other part of that product and the equity is to do just that. So it's assuming there's a sponsor that you guys have or a client that you guys have that has a portfolio that may, has some been around for a while, so they probably have some equity in certain situations, and then maybe they don't on some recent buys that they've made, or product type maybe driving, their lack of equity. We would come
Yeah.
in at the holding co or the opco level, and then provide them some liquidity so they could rebalance their portfolio. A, B, maybe free up some capital to take advantage of some more opportunistic type of deals given the market cycle. We'll see what happens. And then that trickling down from that equity can come in the form of common, it can be pref, could be LP equity. We'd have probably all the LP equity.
Yeah.
And as far as the parameters, other than the geography, which is national for the equity program, deal size, deal type, product type, it's all the same.
Okay.
Yeah.
So everything's the same. We didn't talk about LTVs before. Can you dig in a little bit to the LTVs and kind of where you would come in on an equity position? Your comfort level of where they're at today.
Yeah.
I know you're talking about buying non-performing, but
Yeah.
a
Aside
little
from the
bit different.
non-performing stuff, right? So, yeah, I think that, the equity is pretty flexible. The timeline, the investment timeline for the fund is up to 10 years. So if you think about long, more patient type of equity, and you could structure that as a current pay or some sort of kicker at the end or a combination of both. So it can hang in there. So it's really designed to get through a more depressed macro environment, and then as it trickles down to certain assets in the portfolio to be able to help
Okay,
out.
cool.
Yeah.
Are you gonna go nationwide on your preferred equity, or are you still sticking Texas? I'm assuming you're sticking Texas to West, but
That's national,
we're getting
actually.
them everywhere. It's
Yeah, no,
national.
equity's national, primary and secondary markets at national, debt, bridge debts, Western US.
Got it. Got it. So,
Yeah.
um, how would we play on those equity style deals, since we're typically gaining commissions on a debt finance deal and we charge origination, right? When we
Yeah.
start playing on this equity fund side, this isn't distressed debt. This would be us trying to help bail someone out before they get to the
Yeah.
distress stage. I mean, how would the compensation look, and how would our role play as the brokerage? I mean, just normal broker stuff. How would you
Yeah.
guys pick it out?
I don't think it'd be a deviation from what you're doing. I would imagine a lot of what you're doing now.
Yeah.
It's engagement by the client. Client typically borrower typically pays those fees, an engagement fee on the debt. No different than the equity.
Yeah.
And we would work with you in the same way we would on a debt
Perfect.
request.
Do you guys have do you guys have a white label program, table funding? Just
We
curious.
don't. We do everything. We just do all our own stuff, and it's all balance sheet.
Okay, all good,
Yeah.
all good.
Yeah.
All right, man. That's all I got for you in terms of like a quick interview. I want to open it up again once more to anybody else on the call to do a question and answer session with Darren. If you have any scenarios, I know Darren, we've been pushing a lot of scenarios away that are straight up upside down on the
Yeah.
takeout. They need money. That's been like the last month. I'm not kidding about that. So I'm sure we all have maybe people to hit up afterwards and come
Okay.
to you. But does anybody have any scenarios right now that might line up for Darren? I will say, Darren, most of our deals are small balance deals.
Yeah.
So around that $5 million mark is like the majority of what we see. Every once in a while, I get those larger deals where that person's having a tough time getting lending, and that's when we come in. So, majority of our stuff probably around $5 million max. But
Yeah.
if I start rolling, if we do see those big ones, normally we try to avoid the really big ones. Oftentimes they end up being pipe dreams a lot of times, man, especially the people we're talking to. But
Sure.
some of our guys are pursuing the larger deals, and so yeah, I'm happy to have you as part of our group. And yeah, does anybody else have any questions for Darren? Darren, I'm going to let you go here in a minute if nobody else wants to chime in.
No, yeah. Thanks again, guys, for having me. I'm certainly happy to answer any questions now or offline, whatever works for you. And there will be scenarios that you run into bigger stuff, and we'd love to be helpful there, both on the debt and the equity side. So
Money, man, money. And
yeah.
no, you won't do portfolio SFRs, right? You won't do those?
No
Oh,
SFR. I just don't have the mandate for it. I mean,
yeah,
sometimes it's good to having a discretionary fund, but it's also it's impediment when you see a good opportunity, but you can't really step outside of it just because you raise capital around a certain strategy, and your first deal you do that isn't in the mandate, the investor's like, well, what are you guys doing? So
yeah, yeah, right on. All
Are
right,
there
cool. Well,
certain?
you go ahead.
Oh, I was just saying, are there certain projects that you guys do like as far as the equity part?
yeah, just the kind of the same stuff that we're targeting on the bridge. And I should add, we can be both pieces of the capital stack on equity and bridge, which is kind of some differentiation. But now to answer your question, Justin, it's those four major commercial real estate groups, and then those medical office, life science, IOS yards.
Office, retail, warehouse, medical office, storage,
Multi-industrial. Yeah.
multi-industrial.
Hospitality, no, like a hotel.
Can't do hospitality unless it's a conversion to multi.
Okay.
It's just
How do
too
you feel
big.
about
Yeah.
STRs, multifamily operating with STRs? Kind of like hospitality, but it's not.
Yeah, we've actually funded some of those. So because usually those are usually underwrite to a multifamily deal to get it sized. So those we can do, like extended stay stuff, talking about. Yeah.
I don't know, man. They're short-term rentals, so like
Yeah.
Airbnbs, that kind of stuff. You know, we're getting a lot of multifamilies that are operating like that, and unfortunately, they don't have long-term leases. They're just operating a short-term rental business out of their multifamily. It's like, man, they should have long-term leases, but
Yeah.
they haven't figured that out yet.
We
So
can do those. Yeah.
sweet, man. We get a lot of those,
Oh,
and
good.
most of the lenders don't like those. So
Yeah.
you know, you could fill a gap for us as long as we get those larger deals. So.
Yeah.
Right on, man. Right on. Well, everybody, you're gonna see this this interview archived. So you guys go to the lender archive, you'll see it there. Darren, please fill out that Excel sheet,
I
brother,
will.
that I sent you. That'd be a huge thing when we send this email out to everybody that's in our program. Everybody's gonna see that Excel sheet, know what you do, know what you don't do, and be able to send you deals. If you want to respond to that email too, brother, with any kind of material that you want, send that out. Everybody's going to be able to see it right from that. So you just reply all and it'll get sent out to everybody. So,
Great.
right on, guys. Well, thank you so much, Darren. You're the man.
Thank you,
Everybody,
guys.
you know how to get a hold of Darren. We'll send his contact information out after this call.
Thank you, guys. Appreciate your time.
Yes, sir. Thanks,
Okay.
Darren. Take care, brother.
Yeah.
Yeah,
Bye.
bye-bye.